financial services, so
Yeah.
get away from it.
How our favorites change, Piyush? It
Yes.
used to be my favorite, like Madhukar and my both, till just 5 years ago, right?
So
Eh,
the only thing I have to tell you guys is that the first deal I was looking at multiples was a deal that Anand did not let us come in. So, that is the background. And
yeah.
that was actually the first deal I was looking at multiples. Very excitedly. Chaliye, I
Chalo.
will I will quickly get started. Thank you everyone for attending. I am going to talk about why lending is not just a feature, and we'll look at some of the data and a few things as a part of this deck. Very quickly. I don't know why this is not working. So I'm a part of Vertex. We're a global network of funds. Just wanted to give you an introduction. You'll see the slide later. This is our portfolio in the fintech world. Bunch of companies out of India which are highlighted in green, Niam and Kisht being two, and then on the tech side there is Scienzy and there is Reco somewhere in the fintech world. So this is what we're gonna cover. I guess Shruti would have sent this over to you. Um, and we'll also understand what this means. This is a I hope by the end of this presentation, you guys get some perspective on how to understand this business model. Okay, so we'll start with a market map. This is the entire fintech landscape as I would think about it. And you see unicorns present scattered all over the map. But the one segment where you see the least number of unicorns is essentially lending based companies, right? So both on the consumer lending side and on the SME lending side, like SME term loans, there are some of the older unicorns that are present, but like on consumer lending especially, there are literally no unicorns apart from Policy Bazaar, and which has Paisa Bazaar. And I don't think I'm going to answer that question why that is the case. I have some hypothesis, but that's not the outcome that we are trying to get at the end of this session. But this is a very interesting thing that you'll see in the market, especially in India, in the world of fintech. So you know we are basically discussing lending, unit economics and metrics, etc., right? So why don't everyone just get started and tell me what are the constituents of a lending business? Just feel free to type out, unmute yourselves. We'll take a minute and just hear out everyone's perspective on what are the constituents of any lending business. I'll jot it down. Please participate. Okay, we have one chat. Cost of capital, that's correct. That is NIM, that is also correct. NPA, IRR, that's right. Anyone else? Okay, so these are AUM, that's also fair. All of these are sort of uh, all of these are sort of the metric outcomes that we figure out when we are lending, delinquency ratio, etc. So we'll cover almost all of what you guys have mentioned. But conceptually, when we look at lending as a business, there are three broad buckets. Everything in lending is sort of covered, right? One is origination and distribution, where you originate your loan and how you originate it. And the big question that everyone asks is, can you build a moat around distribution, or is distribution completely commoditized? Then there is underwriting and operations. So how do you underwrite the user, the customer, be it a business user or, and so, when you think about this, like in your mind as I'm talking, like just keep a view that we'll talk both about consumer and businesses as the end customer. So it's very interchangeable because the basic concepts apply. Underwriting and operations, and then there is collections and recovery, and these three form the building blocks of any lending business or any lending operation. Traditionally, there are companies, the traditional NBFCs, the really big ones, actually used to have a trifecta team of three people who would tie in together and do a bunch of loans together. So in a branch-led model, you would have a sales lead, you would have an underwriting lead, and you would have a collections lead, and all these three would sit in the branch and they would together form the branch, and the operation was clearly divided among these three. And even today, as you go into lending companies, and good lending companies have built their businesses along these three axes, and we'll talk about all of these. And sorry, one second. Right? And then, the other important part to understand about lending in general, especially I'm starting with consumer here, is how you assess the customer, right? So you assess the customer basis the nature of spend, why there is a problem associated with that nature of spend. And I'm running through some of these slides. You can look at it later. These are slides that we've made for internal consumption, so you can look at it later. But this is just to set the context more than anything else. And then what are the potential solutions? So as you see here in the consumer world, there are a ton of modalities of issuing a loan to a consumer who desperately wants a loan, right? So there is affinity-led lending, which is essentially what Bajaj does, or you can get like a loan on Make My Trip when you're booking a ticket. There is subvention, which is again something that Bajaj does, and this is by price point, right? So at different price points, these things work. So asset-backed loan, gold loans, for example, are there. Credit card, short-term personal loans, which are just like you get money in your bank account in 20 minutes. There are rentals, which is a lending product in the garb of a consumer rental product. There's microfinance, BNPL, EWA, payday, etc. These are all kinds of loans, and there are questions around and thesis questions around each of these. But essentially, there are many products available. All of these products are trying to get to assess the customer along broadly these 5 axes. There is income level, formality of income, credit record, KYC onboarding, and surrogate and alternate data, which is something that's come up in the limelight recently, but it's always been a big thing for lenders to lend against. So for example, going back, let's say 15 years, like lenders like Shriram Transport used to actually have a health scorecard in their lending profile. So the driver that they're lending to, has there been any health record of his that we can figure out, and is there a health check mark? And people now talk about a lot of these surrogate data. Actually, all of this has been used in the past in some shape and form, in the potentially as tribal knowledge. So with this background, this is how the SMB could look like, and I'm not putting it, you can use it. Let's get to the bottom of what we're trying to solve for here, right? This is how the structure of any lending business should look like. If you understand this in depth, you will get most of lending businesses as you go through. And this is inherently the data I've put here is for like a model post PMF startup or a fintech company that's achieved some kind of a scale in an NBFC like kind of a model, and we'll dive deeper into all of these. So at the heart of it is interest income that you generate. On top of that, there is substantial fee income that's available in lending. So you end up with a total, like if you think each of these squares as a 5% block, you can end up like a good NBFC should generate about 24-25% total income as an IRR on an annualized basis. I'm not going to go into how to calculate the IRR. That's very different. It's available in Excel, so do it. Then you basically subtract the cost of debt to get to what is called the net interest income. I think net interest income as a net interest margin is what is the essential building block of equalization across all financial businesses. So you're either balance sheet led or asset light, as you might want to call it. But when you compare business models, you compare on net interest income basis. And there's another nuanced way of comparing. You compare it at risk adjusted net interest income, which is net interest income less credit cost, is essentially what is the income generating capability of the business that you've built. So risk adjusted NII is what is like in mature businesses is how you'd go about comparing them. And most mature businesses in financial services should get measured on these. But we get to NII, and then there's obviously the CAC, which in common parlance is also the marketing and sourcing cost. There is credit scoring, which is the underwriting, operations, KYC, document collection, field staff if you have field staff, etc. There's G&A, which is your central teams, which is obviously going to be a smaller cost. And then there is the credit cost. Broadly, if this is a 24% IRR business, that has a 12% cost of debt. The NII is 12%. Broadly, CAC is 3%, underwriting is 3%, credit cost is 3%, and ROA is 3%. That's like, in this kind of a business, this ROA tree looks like this. Now, I'm going to pause here. Like, if you have any questions about this ROA tree, because it's like, if this is clear, then all of fintech will become clear for you, and we'll sort of go, all of lending led fintech will become clear for you, and we'll go through some of these things in depth going forward. But just
Sorry,
like,
Piyush, how do you define credit cost, and where
Yeah.
is cost of collections coming?
yeah, so that's a good one. So typically, cost of collections would sit under G&A, but cost of recovery would sit under credit cost, typically. Right? So you have a central collections team that is sitting in the office and calling out, and you're doing all the tech work for that. That sits under G&A, and like, if you send someone out on the field to collect, that's the credit cost that sits in the credit cost. So this is loan loss plus collections, on field collection cost, broadly.
Got it.
Piyush, one question here. So when you say net interest income adjusted for risk, so what exactly are we adjusting for here? What are the factors that go into it?
Yeah, so basically that is the way to understand what is inherently the business, how remunerative inherently the business is. So when you think about really mature businesses at a macro level, a business model will have a certain defined risk profile. For example, credit cards in general have a 3% risk profile. Now, how you manage your top line adjusted for that 3% risk profile, or that whatever that credit cost is, essentially tells you how well you're sort of being able to cater to the market where you're operating. So risk is essentially all the credit costs that you will get on a static basis, and we'll talk about static pools later on. Your NII less all your credit costs should tell you what is the risk adjusted return. And when you compare different businesses in a stable state, different businesses will land up on, depending on how operationally intensive they are, they lie on a continuum of risk adjusted return basis.
Got it. So if I've understood correctly, it's essentially adjusting for the default, which is related to whatever loan product is being given out by the company.
Yeah,
Okay,
that's right.
got it.
I also had a question here. Just wanted to understand how you would account for velocity here in this, right? In the PN here, assuming a company that is exactly similar on all these sort of heads from a number perspective, but has a lower tenure of loans versus another company that has a higher tenure. So it's like churning capital much slowly.
Yeah. So this is on average AUM base, average numbers on an AUM basis. So you have to basically, this is annualized. So there are products that are 3-month products, and then there are products that are 5-year products or 3-year products. All of this is annualized. And we'll discuss the credit card business model in a few slides, and you'll see that at the end of the day, every business has to be compared on a common ratio basis. And so this is the most common way of analyzing businesses. Now, some people might come and tell you that we are a very short term business, so we are a 1-month product, for example. And so, they don't talk about this ROA tree in any shape and form, but that's the wrong way of looking at a business, unless it's a pure fee based business. Because what you have to do is you have to account for everything on an annualized basis, and then build an ROA tree along this kind of a measure. You can pick and choose how to put things where, but essentially you have to analyze it on an analyzed basis.
Got it. Thanks a lot.
Okay, sorry. When I say you have to, it means I do. That's how I like to do it. Please don't take it as prescriptive that you don't have to do anything. You have to figure your stuff out. This is how I do it. Right? Okay, so we'll now move on to a few case examples of businesses that exist out there using this as an analysis, right? And then we'll do more, right? So now think of origination marketplaces. I haven't put any logos here, but think of origination marketplaces like Paisa Bazaar, Policy Bazaar, Bank Bazaar, etc. What are they doing? They are saying, we do origination for you. You do everything else. We will do origination on your behalf. So please pay us for it. What do they charge the bank, or which bucket are they attacking? They are attacking the fee income and they're attacking the CAC, right? And so they are operating in this plus this of the entire AUM of the lending industry that they operate in. That's the TAM. They also will come and tell you that we also help you do some credit scoring and also help you do some of the operations. So please pay us. Eventually what happens is that all of these businesses end up not getting paid for any of the additional stuff. They only get paid for origination. And why is that? Because any bank or any NBFC bank, I'm saying like as a generic term, will share some fees, but they know that when their underwriting model is being used, or when their scorecard, as they call it, is being used, they will not pay anyone any penny for any value add they do. So if you look at Bank Bazaar or Paisa Bazaar, to the best of my understanding, and like I'm not a shareholder, so don't quote me on it, they primarily accrue income from this bucket and some income from this bucket, like primarily from the CAC bucket and some income from the fee bucket. And that is like, so that, so that's how you will analyze that business. Now that is a pure marketplace consumer internet business. So there are lots of marketplace analytics or analysis that you will end up doing on these kind of businesses, like LTV to CAC, retention, repeat rates, etc., etc., etc. But from a pure fintech perspective, the only thing that you're getting at is that they're getting some money out of CAC and some out of the fee income, right? So these are origination marketplaces like Bank Bazaar, Paisa Bazaar, blah blah. There are many of them. Now,
And they get paid on converted leads, right? Or
it varies. It actually varies. The models have become extremely complicated these days. Some get paid on logged leads where the bank is going to convert these. Some kind of, so for example, home loans, all of the payout is on lead logging, less on conversion, because that's a very offline product. And the payout there is also very tiny, by the way. So if you want to consider like, how can you get like 2.5% from a bank, that is on a converted lead basis for a loan.
got it.
Right? So now with this origination marketplace model in mind, let's do a thought exercise, right? And let's do a thought exercise around an agent aggregation model. Have any of you come across these kind of models in any other business? Think of it as Misho, like a reseller model. So in personal loan markets, which is a huge market in India, startups and fintechs don't even scratch the surface, right? They're a tiny part of the market. A large part of the market, maybe 40% of the market, is agent-led. So these are agents that are insurance agents, wealth agents, CAs, your uncle, etc. Sorry, not your uncle, my uncle, etc. They will go and sell a loan product to someone, and then they go log that case with the bank, and the bank pays them some percentage as origination fee. So now do a thought experiment and think about, in the lending world, can you build a startup, or would you back a startup that is doing agent aggregation? Like Glowroad and Misho are doing reseller aggregation. Can you build a model that is doing agent aggregation? So what are like some of the things that you'll think about? Again, unmute and please speak. And we are talking like again, this session is about the dollars you can make out of this business, right? The metrics of it. So think metrics. What is the good and the bad around the metrics of such a business? Sorry, is there something on the chat? I can't see the chat. No chat. Yeah, no one? Let me get started, right? Positives, right? Positives are, agents are already a thing. Banks are used to paying them X percentage of the loan. And so if they give better tech, if you give better tech to these agents, and there are already preset programs in banks, you can make some money out of it. What are the challenges with this business? We discussed the marketplaces, right? What are the challenges in this business? Okay, you don't own the customer, you as in the company. The bank doesn't own the customer, actually you own the customer. So like, for example, the agent is the customer now, yeah, but you still don't own the customer. But what are the other challenges? Think numbers. Retention of these agents, that's fair.
CAC.
CAC of acquiring these agents, that's also fair.
I guess
Reduced
the
margin.
market is just that 2 to 3%, right? So is the market a problem?
Yeah. Can you expand on that, Aditya?
I guess if you look at the entire AUM, your agent-led models will only make 2 to 3% of that, and you as a tech player will make even smaller.
Yeah, exactly. So essentially what you're saying is actually banks are used to paying larger pools to larger agents or larger agent groups. So they might end up paying 3% to an NJ Invest. Check out this company called NJ, a fairly large company that is just an agent aggregation business. But what NJ does is they work with like very, very small, very, very fragmented agents in tier 2 markets. So what they get is essentially NJ gets 2.5%, they pay the agent 2%. And as and when an agent starts becoming larger in terms of loans, the agent starts earning more like 2.5%. And so NJ is literally left with zero. So actually, in my view, this agent-led model leads to margin compression as you scale, which is super counterintuitive. It happens in insurance, it happens in lending, it happens in everything financial services. So that is a big thing that happens in these kind of models. There are still a lot that get funded, but yeah, that is not something that I have to talk about. So yeah.
Hi Piyush, just another point. I'm not sure if it's valid or not. Would, as an agent grow, maybe in number of loans he's getting a bank or an NBFC, would that also lead to maybe leakage from like a startups model, as in
Yeah.
that? So
Yeah,
retention
so
might also be.
agents churn out, they get direct login codes with banks, they get competition who wants to poach them. It's a messy business. So I haven't
Thanks.
seen good unit economics on any company that's doing aggregation of agents in general, because of all of this.
Yeah, I have a point, Piyush. I've also seen that most of the times the good leads the agents will anyways give to the banks.
Yeah.
The bad leads they will log in here, right? Which you will give to the bank, right? So which there is some kind of cost which you incur, which will not result into any loans, irrespective.
Yeah. So like think of the agent as the shrewdest guy on the street, okay? In this model, they know more about this market than you do, as a startup. So this is the agent aggregation model that we spoke about. Okay, now we talk about asset light, right? There are tons of companies that go talk about asset light business models in lending. We don't take loans. We do off balance sheet, right? And these companies work with 10% FLDG or higher or lower or whatever. What are these companies inherently? We saw the ROA tree, right? So on the ROA tree, these companies are saying that we leave out the headache of the cost of debt because we work with bank partners, and we will only do this component of the business, which is the net interest income business. And so everything else is on us, but the loan is booked on the books of the bank, right? So so we will be super capital efficient, which is the most important part of this business, right? Because what they're saying is that we don't need to go raise debt, so we don't need to go raise as much equity to manage this debt, and so it'll be extremely capital efficient. But what literally really happens is what happens after the ROA, right? There is a thing called leverage in this whole world of lending, which means if you have $10 worth of equity, by definition, how much leverage you can get. And that is linked to what is, there are various ways of defining leverage, etc. But essentially, it's debt to equity ratio. How much debt you issue on your books versus how much equity you have. This leverage is actually a huge equalizer when it comes to off-balance sheet businesses. Can anyone tell me why? So think about you're doing, or a company that you want to finance is doing an off-balance sheet business. They're saying, hey, we can grow infinitely because we have partner banks who are willing to give us their book to lend on. And so like we will never have any problems in scaling and we'll not need to raise equity to sustain ourselves. Can anyone tell me why this is a inherently logically flawed argument?
Piyush?
Yeah.
Piyush, Rishabh here. So probably because the company is not taking enough leverage, and a good business is always kind of balanced in terms of leverage they take.
No, the company is not taking leverage, that's fine. But the argument here is that, hey, we are not even bothered about the debt. You worry about the debt, you worry about the balance sheet. We only give you loans and you only give us like the net margin. We don't care about the debt, etc. That's not what we are here for.
About 10% FLDG acts as a barrier, right? Wherein
so 10% FLDG actually allows you to get up to 10x leverage, right? Because you have $100 worth of equity, you give 100 as FLDG. That means if it is 10%, you can get 1,000 rupees or $1,000 worth of balance sheet to lend against. I'm saying even that is a flawed argument. Why? And by the way, 10% FLDG is like the good companies with good credible founders get 10% FLDG. Most companies will get 15% FLDG. There are stories of unicorns who work on 100% FLDG, but that's for a different time and place.
Piyush, I think two things. One probably is the dependency risk, because like in the pandemic, if the capital dries up, then that capital basically is not something you can have like equity, which is still with you. Second, I also think in models which are off balance sheet, banks have a higher say on which customers you can lend to and not to. So they can sort of put their hand there. And I think that then the fundamental idea of the startup then doesn't sort of hold valid, right? So that is the other point.
So you're actually, the answer to this is very simple. You're working with very smart people on the other side. So bankers who are doing this business know what is the business, right? So they will actually control the leverage you get. They will not allow you to exceed a certain threshold of leverage artificially. Doesn't matter how much FLDG you have. So in similar cases, like if you try and do an off-balance sheet business and you go ask the founder about, why aren't you getting more lines, etc. The real answer here is that if you are a small company which is doing off-balance sheet and you've raised, let's say $20 million or $15 million, the bank knows it and they will only allow you to lever up 4 times because they know that at a certain net worth, the leverage in the market is this much. So truly there is no off-balance sheet business that you can think of, because the guy on the other side is extremely risk aware, not averse, but aware. And so at a certain level of equity, they know exactly what is the leverage that you'll be allowed to have. And that has played out in every company that has tried to do this in the market. Right? So yeah, so ROE is basically what they look at. So let me then again also talk about, like we've discussed some of these points before, but off balance sheet is actually not a new concept at all. it's existed forever. It was actually a huge thing back in 2005, 4 to 7. So this is basically trying to get loans off your balance sheet. It was a huge thing in India. It was the life and blood of NBFCs in India pre 2007. Every single NBFC that you see listed today or unlisted used to do huge amounts of securitization, and they really had very small balance sheets. And at that time, they could lever up like 15 to 1 and whatever. And RBI came down so strongly on it and they shut down securitization altogether. This is like the OG way of doing off balance sheet, right? You book loans, you sell them off. And RBI did it before Lehman collapse, right? They did it beginning of 2007. So, like or sometime around 2007, 2008. So, you are living in an environment where the regulator is possibly the smartest and the most advanced regulator in the world. Like RBI is possibly the smartest regulator worldwide. So they shut it down. It has come back in vogue today in the form of FLDG. I will go out on a limb and say that in 3-4 years, once FLDG starts becoming a large business, FLDG-led lending starts becoming a large business, you will see fairly stringent regulatory action coming down from the RBI on FLDG. Right? So we've all seen this movie before. It's not like, it's just a new garb today that people are wearing, but once it starts becoming larger, there'll be a massive clampdown. So I actually think in lending there is no construct of Assetlight unless you're doing pure marketplace business where you are getting the banks to either change their models or you're getting banks or you're using banks models. If you're getting banks to change their models, there can truly be an asset-light business that can be built. But sadly, we are in an environment that over the last 3-4 years in India, the lending business has gone through so much strife that no one has really been able to truly impact that piece, getting banks to change their underwriting models. So we'll move on to this whole idea of building better underwriting models for banks. You can do it two ways. One is basically selling banks a credit scoring model, which helps lower the cost of credit scoring or underwriting and helps improve or reduce the credit cost. There is no risk in this model. This is like a SaaS model. Some companies have tried to do it. Or you can get them to change their models and then do an asset-light business, which actually will be extremely remunerative because then you can have literally infinite capital or infinite leverage. But sadly, there aren't any such models in India that have come about. It'll also need a different kind of a founder profile to get this done, which we haven't seen anyone try to do yet. So this is another of those business models that can come about in lending. And then there is this brand new piece, which is around collections, which is everyone has spoken about, hey, we will do better lending than banks. Now a few set of people are coming up and saying, hey, we will do better collections than banks. And collections is an area where tech is literally zero, workflows are literally zero, processes are extremely legacy. And here is also a segment that not many understand, in that banks have been used to outsourcing collections to small agents and agencies forever. But these small agencies have traditionally been either goons or, goon-like, who will go out in the field and threaten people to get the loan. But now with tech, you can actually improve the workflow significantly, potentially cut down credit costs by a significant margin, and walk away with a huge upside. It looks like a small bucket, but this is a huge business which has already got precedence in India. So auto calling, auto generation of legal notices, and so on and so forth. There are so many things that can be done on the workflow in this business that it's not funny what the potential is. So till now we have seen how different businesses attack different parts of the ROA tree. But it is, at least from my perspective, it is super important to keep in mind that any lending business has to be looked at, or any business that touches lending has to be looked at from this lens of attacking the ROA tree. Okay, any questions till now? Otherwise, we'll move into next set of discussions.
We just wanted your thoughts on, you said this is a good, interesting opportunity. So how large is the market here, and why is this scalable from a tech point of view?
Yeah, not from Vertex point of view. I don't have any investment here. I'd like to, but that's a different story. So think about the entire credit market. So here is the thing, right? When we are discussing fintech, we think that fintech, unless it's brand new models that have never been monetized by banks, we think that fintechs will be able to take away anywhere between 1 and 6% of the market, right? So lending, for example, if we get to 6%, we are like, as an ecosystem, golden. All of us will make a ton of money if we're investing in fintech. This applies to the entire basket. So not only does it apply to the entire secured finance market, like home loans, like asset loans, etc. It also applies to the huge category of personal loans, large ticket personal loans that are underwritten by banks and credit card companies. And it also applies to, stuff like two-wheeler loans, car loans, etc. And the way you have to think about it is, it's more to do with process improvement, process optimization, which has tremendous value and has never been tried before. So so in the TAM SAM debate, right, that I'm sure you guys have heard, the TAM SAM debate, for fintech lending, the SAM is like 5% of the market potential, or 6%, 7, whatever, 10%. For this, the TAM and the SAM are the same, which is 100% of the market, which is why it is so exciting.
Got it. Interesting.
Yeah. Okay. We'll move on. I have a bunch of other things to talk about. Okay. So this is one of my favorite topics, and this topic became very prevalent and very widely discussed when the SBI Cards IPO happened, because that was the only card IPO that can potentially happen in India for a long time, till some of our new age neobanks go list. But here is a overview on the credit card economy, and I won't spend much time. This is all just research. Essentially, cards is a fairly underpenetrated market in India, and UPI is here to kill it. But understanding card as a business model is actually extremely important to understanding payment plus credit as an opportunity, right? Because this is the most mature market model that is out there to address that opportunity. And I think it's, so, there are three broad things that address payments plus credit all together as an opportunity. Credit cards is obviously one of them. Some of you might have heard about credit on UPI, which a few people were very vicariously, so to say, doing, which is obviously not permitted under the regulatory outline that we have. And the third, which is the most talked about topic, is literally BNPL. So this whole construct of payment plus credit as a value proposition, it's best understood through the view of a credit card, because that's the most deep market out there. So credit cards actually generate a blended yield of 20 to 22%. And I'll remember the ROA tree, right? So we are all going to talk about everything from that ROA tree perspective. The entire ROA tree of the credit card remains similar to any lending business. The nuance lies in getting to this blended yield, and how do we arrive at this blended yield. That's the nuance in the card business. Everything else is identical to any other lending business, right? So I thought I'll sort of do a deeper dive into the card model and how do you arrive at this blended yield for the card. Like I said, card is a spend plus credit product. So people are spending $100 using a card, and use card, credit on UPI and BNPL interchangeably in this model, which is the reward model, you are left with a book of $18. And this is a India number, but it's very much a global number as well. So if you look at SBI Card's annual report, you will see for $100 of spend, that the GMV that went through the system, the outstanding book at the end of a period is about 18%, right? Which is broadly 1/6. So the book revolves 6 times a year, so to say. And so that's the way to understand this in common sense. And this is because a lot of people who are transactors, about 2/3 of people who are transactors, pay their balances on time. Just use it as a payments product, and at times often access the rewards that come with the credit card. Then there is a bunch of people who are called revolvers. They'll typically not pay or pay the minimum. The largest percentage of revolvers are who pay the minimum or pay less than minimum, and therefore start paying fees on this, fees and interest on these transactions. And then there are the defaulters, which is like 10% is a placeholder. It's much smaller than that. And so these transactors pay the card issuer no interest. The revolvers and defaulters end up paying 42%. That's the market rate in India. If you pay minimum on your card, you're actually paying the card issuer 42% IRR on the entire value of the transaction, which is the $100. So they pay 42%. And then the rest of the market is a huge market, which is the credit card EMI market, which is about 1/4 or a quarter of the book is the EMI market or a credit card PL market, which basically gives 18%, slightly above the personal loan rate. And all of this together arrives at the 22% blended yield for a card, 21-22%. It's in that range. So actually, if you look at it, it's the revolvers who are helping, you and I use the card and get some of the rewards, which is now a well understood thing. But if you read the title, cards business is like a movie business, right? A cinema business. That is the way I see it. And why is that? So the idea here is that the card issuer or SBI Cards or HDFC Bank makes literally no money on what is commonly perceived as the MDR or what they charge the merchant, because the MDR plus annual fees, which is the revenue, which is what people perceive as the revenue, is akin to ticket collections, and all of the cost of servicing just the transactors and the financing and the rewards actually makes up for all the fees that you're collecting in the form of MDR. So you really make money on revolving users, and getting that ratio right, what percentage of your users are revolvers and how much of your book is in the revolving category, basically makes for the bottom line of a card company. So you really make money on selling popcorn and Pepsi to these guys. So this is the card economics. I wanted to spend a few minutes on this because BNPL is all the rage, but it's far out from getting established in this form of economics out there. I guess if you ever look at a BNPL company, ask for data in this format: how many people are transactors, revolvers, and defaulters? What is the book breakup in transactors, revolvers, and defaulters? And what interest are they accruing? And try to understand the yield, because literally no one will tell you, none of the BNPL companies, and I've spoken to a few of them, tell you data in this range, in this format. But if you do, you will understand like the nuts and bolts of that business very nicely.
Just a quick question on the cards itself.
Yeah.
Typically, what is the revenue split of MDR versus interest income?
Yeah, good question. Off the top of my head, I would say that it's almost equal. MDR plus fee should be almost equal to the the interest income you make from defaulting customers, defaulting, and including the EMI, the CC EMI and the CCPL, which is a large book, by the way. If you combine both of those, it should be equal.
Got it. And is that like a industry benchmark, ki 50-50 and as close to 50-50 as possible?
It almost is, yeah, Aditya. I think it almost is. Like if you look at, like even if you look at a mature, sorry, I keep bringing back BNPL. If you look at like a mature BNPL play like Affirm, Klarna, you will see the same ratio there as well.
Understood.
Yeah. Okay, so I'm hoping that this has been helpful. BNPL, there are concepts around BNPL. Broadly, if you look at a BNPL model, economics is actually very similar. And I'll come to this third point later. But economics of a BNPL, or how you should look at a BNPL business, like I said, should be very similar to the way you look at a card business. The only difference in BNPL, and I think inherently why it is a better model, is because you don't deal with legacy architecture. So just issuing cards and issuing credit cards is for the big boys, but BNPL is literally democratizing that form of credit. And so it is truly what tech can bring to credit in its truest sense, because it can be a pure API business. It can be turned on or off on the click of a, literally a button or a feature flag, as you would call it. It doesn't need, long-term T+2 settlements and recon. The recon is real time. Failure rates are much more transparent. So it's very truly a tech product. And so therefore it should get more traction. And there are
And so would you say that the value proposition of BNPL or the reason why it's scaling up so much is because of the value it adds to the merchants versus the consumers?
It actually adds value to both ends of the spectrum. And I want to take a very India specific approach to this, right? India specific view to this, because global markets are very different from India payment markets. In India, inherently, the penetration of cards is lowish, and it is only in a certain segment. Even today, like after we have issued whatever 20-30 million cards through COVID, the penetration of card is still low, and it's very restricted to a certain socioeconomic strata or a demographic strata. So solving for affordability at grassroots on purchases or at point of purchase is actually BNPL can do better than cards as it stands today, right? So it adds value to customers. It also adds value to merchants because you can solve for affordability and therefore sell more. I think in India, while it adds value, I haven't found it to be a very palpable unit economics beneficial business model. And I've sort of written some part of it down in the economics part of it. I inherently think BNPL works very nicely when the MDR a BNPL provider can charge the merchant is high. And the reason for that is BNPL is a new category. So you not only have to spend money to acquire the customers, you have to spend money to retain the customer and to get them to transact more. And it has a cold start problem. Even in a market like US, where a firm is so large, they still get 5 to 6% MDR for their BNPL in a market where the credit card MDR is 3%. So they are literally double the credit card MDR. In India, the credit card MDR is actually like 2.5% is dreams. It's like less than 1.5% or less than 2%. So, and merchants are not willing to pay a 6% MDR. And inherently, a BNPL model which suffers from a cold start problem cannot work at 3% MDR ever. So there is a problem of economics in BNPL in India, but from a conceptual perspective, from a thesis perspective, it's a phenomenal product.
Just want to add another point here. Just if you look at Square, and Afterpay, right? Afterpay is essentially BNPL, but then BNPL comes in more as a feature, don't you think? Wherein eventually, and eventually the company has to finally offer more products to its users. Essentially, I mean, BNPL as a business on its own, right? It's just one part of the entire market, wherein just being a singular player on BNPL, you scaling up is probably difficult unless and until you offer more products.
Yeah. So I 100% agree, Sonali. Um, I'll put it slightly differently, and I have a slide in the deck at the end for that. I think for a financial services business with lending at its core to be successful, you have to have multiple products inherently,
Absolutely.
right? Because what you're doing is you're offering multiple products to your customer. So inherently, you need to be a multi-product business, which means that for Square to add it to their repertoire was like a no-brainer kind of a thing. So goes without saying. I also think that sooner or later, what's going to happen is someone will do this. I'm hoping, I'm involved in such a company, but sooner or later, what's going to happen is there's going to be a Square, not a Square rather, but a larger fintech company that will come out of India on the consumer side specifically. And by the way, the same thing applies in B2B. So, people talk about BNPL in a very consumer sense or cards in a very consumer sense. The same economics apply on SME when you think about it. Corporate cards or corporate BNPL, etc. The same thing applies.
Right.
But in India, some company will come out which will have, which will start out not from BNPL, will start out from traditional lending, but will build a fairly large BNPL model. Obviously, there is Bajaj, which started from BNPL in the truest sense, and then diversified into many others. But I do think in the world of fintech, there are large opportunities, both on consumer and SME side, where BNPL will be a secondary product as compared to a primary product.
Makes sense. Great, thanks.
Okay, have you guys heard of P2P lending? It's a phenomenal idea. Here is why I think it doesn't work. So we've discussed the asset side of a lender till now. Sorry, I don't know what time. Yeah, so we'll wrap up after this. So we've discussed the asset side of a lending company. Let's discuss the liability side for a minute. So P2P lending, actually, the premise of P2P lending actually solves for the liability side of a lending company. And we haven't spent much time on it, and that's a huge part of it. But inherently, in a developed market like US, when you look at term deposits at sub 2%, P2P can get you 7 to 8%, and you get corporate bonds, etc. P2P can get you 7 to 8%, which is like a huge deal in a low yield market or low risk free yield market. In a market like India, where you get corporate bonds at 8-9%, P2P debt getting you 13-14% is literally not worth it. Which is why it never really was supposed to take off, right? And so it didn't take off. It shouldn't take off. And then there is also the RBI, which is very protective of the consumer and thinks that India doesn't have enough rich people to deploy money in P2P. So they will not let it take off. Yeah, so that's my 2 cents on BNPL. So Akshat asked a question about Bajaj. So Bajaj's model is actually inherently different. It's half and half. Half of it comes from, and you have to understand, Bajaj is not a startup. Bajaj's cost of debt is sub, I would hazard a guess, sub 8% today, right? Their cost of debt is sub 8%. So what I'm going to say has to be looked at from the perspective of that Bajaj has a business what is called subvention, where the merchant or the brand rather pays for solving for affordability. So if you go to Chroma and buy a 60,000 rupee Samsung phone that is financed by Bajaj at zero cost to you, Bajaj is actually getting a 14% yield on that product from Samsung. So Samsung is giving Bajaj the subvention, right? It's a subvention driven product. Half their book is subvention driven, where actually the cost is being borne by either the merchant, which is Chroma, or the brand, which is Samsung, Bose, etc., etc. And the beautiful thing they have done is that they've gone and locked in all the premium brands in the country on their network to give subvention. So you think of furniture, Urban Ladder. Urban Ladder is, Urban Ladder, Pepperfry, but think offline, Evoke, and so on. You think travel, like all the offline travel agents. They have gone and tied up with all of these people on the merchant side to build this network where literally the merchant or the brand is paying them to give this loan. So it's a win-win for everyone, and they're able to do it very efficiently because they have a very low cost of funds. So Bajaj's model is extremely different.
So it's a little bit like, when you think about it, it's like combination of MDR and customer acquisition fees that the brand pays.
Yeah, strangely enough, and I guess an MBA teaches me this, strangely enough, brands treat it as marketing, not as cost of transaction. Right? So it comes out of sales and marketing budget rather than out of, like, if you go talk to Bose and talk to them about or Apple, for example, and you talk to them about this, they'll tell you it comes out of sales and marketing budget. Okay, there are a couple of other questions, right? Mukesh says, are there arguments against off-balance sheet lending valid for BNPL? I don't get that. Do you want to ask that question, Mukesh? Like, clarify?
Yeah. So, I mean, when you talk about BNPL in a B2B sense, you can have players doing off-balance sheet lending as well. So, do the arguments we talked about where the banks are capping the leverage, they'll hold here as well.
So actually, BNPL, it's a different debate and different topic of discussion in terms of business model. BNPL in the B2B world will actually, in many cases, be sponsored by an underlying merchant or an underlying, brand. So you're literally using, so for example, if you're working with, so let's say you're talking to Metro Cash and Carry, and Metro Cash and Carry has all these merchants or SME shops who are buying from Metro, and Metro wants to offer a BNPL product. So it will literally be done via Metro's treasury or a bank that Metro goes and ties up with, and they will sponsor this program for Metro. So they're lending money to Metro, which is being used for purchases by these SMEs or these retail shops. And it's like you need a NBFC in the middle who can go and tie up this program. So BNPL in the world of B2B will work very differently.
Got it. Thank you.
Okay, last one. Nuance difference between CC, EMI and BNPL seems very similar. It is inherently very similar. Just that CC EMI is challenged due to regulation. That can't do guidelines and all of that. So the CMI product was later. There are some inherent, sorry, I don't know what's wrong with the connection. There are some inherent differences, by the way. CC EMIs never work for small ticket transactions. Like transactions and high velocity, high volume transactions, there is no way CC EMI works. CC works. That's more of a different value proposition, etc. in the BNPL space. But for larger ticket BNPL, the other part that is important in CC CC is that traditionally CC companies, credit card companies, haven't built subvention-driven EMI models. It's merchant subvention-led, whereas BNPL has typically been built on brand subvention. These are sort of like a very nuanced way of approaching it, but from an economics perspective, it's very, very similar. Okay,
Got it. Thank you.
so we're good. Anyone else has any questions? Happy to answer. This is my email. Please drop a note if you have any questions. I hope this has been useful. There are more slides that I didn't get through, but that's fine.
Thanks, Piyush. Thanks for your time.
Sure.
Hopefully, we'll see you again on popular demand again. Yeah.
Madhukar, if we have time, and Piyush, if you have time, can we continue on the remaining slides, or is it too big? Madhukar, on you, and Piyush obviously on you.
Yeah, just give me 1 second. Huh? 1 sec. 1 sec. I'm just going to get to my. Yeah, let me do this.
Share that slide.
Yeah. Any obligation to drop off. Actually, I'm going to talk about the next topic, then which is about another topic with more. Okay, you want me to go through? Drop off, please drop off, and I'll just finish this off very quickly. So NPAs, right? How are NPAs measured? Can you guys see the screen?
Yeah.
Yeah. Okay. So I'll do this very quickly. Most of it is there. You can read it later. On an AUM of 100 rupees, and AUM is the net assets of a company. Let's assume GNPA was 10%. So the company had a GNPA of 10 rupees, right? Now, this GNPA definition inherently is 90-day old, which means you actually see a GNPA or an NPA 90 days after it was issued. So logically, you need to go back 3 months and then look at GNPA. This is called lag NPA analysis. Not many startups will send you their lagged NPA numbers, but they'll send you their NPA numbers. So please do this analysis. The coincidental NPA is 10%, but in this case of a growing company which grew from $175 to $100, 75 rupees to 100 rupees, the real GNPA or the quality of assets on that day was actually 13%. And so a lot of people miss this and just see, like in a high growth company, this is super important. Next, on the NPA side, there is a thing called, there's a thing called PAR. So this is inherently portfolio at risk. It's linked to days past due. You should definitely look at these buckets. So don't just look at NPAs, look at what is 0 plus, what flows from 0 plus to 30 plus, what flows from 30 plus to 90 plus, what flows from 90 plus to 180 plus. These flow rates will actually tell you about the health of a business. The movement of a loan from one bucket to the next bucket will tell you about the health of the business, which is very important. And I'm sure all of you have done cohort analysis for consumer companies. Please do cohort analysis for lending companies. Please ask any company that you're meeting to send you loan cohorts. These are called static pools in lending parlance. They've existed for a long time. Please ask for static pools. Please see what is the trend on static pools. Please see at what aging are loans going bad. Please see what is the trend on that. Are they going bad earlier, later? All of this will tell you some questions to ask. Very important to do this. Now let's get to some fun part. There are GNPAs, NNPAs, and write-offs. Most companies in India will obfuscate GNPA numbers using these tricks. So let's understand this a little better. What is GNPA? GNPA is gross loans that are 90 plus DPD. Gross loans less provisions you make are called net NPAs. Right? Provisions are standard and they are based on policy, a company policy. So standard provisions are 0.25% of your asset book you have to provide every year or every end of period. Policy can be anything. You can have a policy that I will provide 100% of the loan on 90 days. What does that mean? Let's see what that means. Let's assume that on 31st March, a company had an AUM of $100. The GNPA was 10%. Now, this is the real picture. But let's say the company provided rupees 8. Okay, they had provisions of rupees 8 based on their policies. So net NPA is 2%. Of this 8, they actually had an internal policy that, or they took board approval and they wrote off 6 rupees. This write-off actually goes off from both the GNPA and the assets. So it is deducted from both the numerator and the denominator. So the AUM will now look 94. GNPA will only look 4 and the company will report 4.3% as the GNPA ratio. Right? Most companies in India will give you this number. Before a fundraise, they will aggressively write off over the life of the loan and they will give you this 4.3% number, whereas the real number is 10. So always normalize for provisions or rather write-offs and look at non-standard write-offs. Always. I haven't seen a company not doing this. Every single company does this. Right? So the extent of how much they do it will tell you something about the management, but every company does this. Yeah. With this, we'll end, guys. This has been good. I hope you guys got something out of this.
Yeah. Cool. Thanks, Piyush. Thanks for your time.
Pleasure.
Thanks for late in the evening. Yeah. Okay.
See you guys. Have a good evening. Bye bye.
Thank you, Piyush.
Thanks, everyone. Thanks, Piyush. Bye.
Bye, guys.